So the best way we do it is to check and confirm the position of the Asian high and the Asian low on those trades before we execute any of the trade. And if you look at this market, you can realize that this is the Asian high. The Asian high, this is the highest point, especially on the stretch during the session liquidity. This is the highest market managed to stretch to at this area of 46.96. Then on the lower side, it was around this area, okay, before that session ends, okay. Then you also mark you also mark the center. It's like today we will make profit, or what is it? This one is also the center. You also look at the center. Now at the center you mark with a very smooth line, because that is always the target on both ends if you're looking at that. But at the same time, guys, look at this. If you look at the previous, there is this previous Asian low that was not collected. Remember that. This was the previous Asian low that was not tapped. So remember, like you always say, this is also a time bomb. Okay? This is also a time bomb. So we have to check on that. We can execute our trade even without considering it, but it might end up affecting our trades. That is exactly what you need to know. So if you look at this is the highest, this is the lowest for the day, and this one is basically the previous Asian low that was basically not collected. Yesterday, we collected the Asian session high. You know, Asian session high, this one. This one is what was collected. If you check it clearly from this end, this is exactly the session that was collected here, the Asian high. But this Asian low was basically not collected, okay? So meaning it's still active, and it's basically a time bomb. So yes, we can execute a trade without considering it, but at some point, it might interfere with us, okay? It might interfere with us, and that is why we have to be very careful every time we make a decision in the market. Now, for those who are asking, how do you draw these lines, especially the Asian high and the Asian low? And remember, all these areas are basically liquidity areas, okay? All these areas are basically liquidity areas, and that is why we're leaving it like that. It's a liquidity, a type of liquidity known as session liquidity. Session liquidity is something that you guys need to make sure you take time to understand how it goes, okay? Because it is one of the most aggressive liquidities in the market, okay? Most aggressive liquidities in the market that you need to be very careful with it, because at any time you might seriously make some serious losses if you're not going to consider it. Now, let's go and look at demand zones. Can you be able to get demand zones that are absolutely outside our demand zones that are outside our trading area, our trading target area? So we have to look at those ones, especially demand zones that are absolutely outside, okay? That are outside these specific zone areas, okay? That are outside these zoning areas. And I can see, if you look at, let's start with H1. If you look at H1 time frame, if you go directly to H1 time frame, you realize that there is this one here that is a very active order block. You see, this is a very active order block. So even if you're going to, you see part of it is inside the session liquidity area. Part of them, it's inside the session liquidity. But you see, this one is an order block for 1 hour time frame. So because it is tapping part of the inside of the zone, I'll first of all hold it for some minute, okay? There is still another one, almost the same place for 45-minute time frame, that it is still tapping almost the same area. Because if you look at it from this angle, this is still an order block, okay? This is still an order block, but it is still tapping the same area. Though, we can really consider the 50% of it, which 50% of it comes to this area here. You see, 50% of it taps this area. But now again, look at this, the previous Asian low that was not tapped. Look at it. So this is the previous Asian low that was basically not tapped. And it's also part of the liquidities that you're having in these specific areas here. Okay? I know you guys are getting me loud and clear. Please confirm to me. I'm rushing a little bit so that we don't miss out on this trade if by any chance it's going to spike. Okay? It's by any chance if it's going to spike. Okay? So that is also another one, if you can able to see it. But now, my biggest concern is, now let's look at 30-minute time frame. I will hold that one for some minute. Let's go to 5-minute time frame. 15, let's say 30-minute time frame. Can you be able to see any order block? definitely yes, there's an order block on 30-minute time frame that I'm basically going to consider as my order block for the day. Because if you look at 30-minute time frame, for instance, if you look at 30-minute time frame, there's this order block here. There's this order block here on 30-minute time frame, this order block. If you can see in 30-minute time frame, there's this order block here. So I'm trying to look at this order block as my favorite for the day. Why am I saying favorite for the day? Because if you look at it, it's basically an unmitigated order block. This one, it's basically an unmitigated order block on 30-minute time frame, and it lies below the previous Asian low and the current Asian low. So meaning, if by any chance this market is going to take out the current Asian low and also go ahead and take out this previous Asian low, I'll basically consider this area as my target area because it is on 30-minute time frame order block, but purely unmitigated. Okay, this is purely unmitigated order block. So it's giving me a positive momentum if basically I'm going to execute the trade because of one, the previous Asian low is above it. So it is below the previous Asian low and below the current Asian low. I hope you guys can be able to see this. It is below the previous Asian low and it is below the current Asian low. So we need to sweep this liquidity and still go ahead and sweep this previous Asian low and definitely be able to tap this. Okay, so this order block here, it's basically giving me some positive vibes to execute my trades from that area. So by the look of things, from where the market is right now, how many pips are we looking at for this market to tap this order block? That is around 396 pips. And nowadays, 396 pips is just equivalent like 30 pips, the ones we were doing like some few years ago. The same time frame for it to tap a 30 pips, it is now exactly the same time frame for it to tap. And somebody was saying, like, it is like right now, in every 5 minutes, gold is moving 100 pips. Okay, gold is very aggressive and it's moving on a very, very aggressive way. Okay, so meaning if I'm going to consider the trades, I'm basically going to consider these. And even further, if I'm going to break it down even further, I'm going to even take 50% of it. So meaning I'll even wait for this market to drop almost 500 pips for it to tap 50% of my order block before I execute my trade. Are you getting it? Are we together? So that is exactly what you're going to look at for today's entry and execution. Remember, we don't make assumptions. Market might choose to basically react from these order blocks that you're having in between, especially on 45-minute time frame. It can choose to react from that area. But does it mean that it's basically going to give us exactly what we want? Look at this. I'm looking at this as an inducement. I'm going to look at this as an inducement area. Because the market, at some point, let me tell you, it might choose to react from this area. But most of the time, it will not. Okay? So what we are doing as traders, we are basically not going to trade against the stretch of our trading. We are not going to go against the rules. And most of the time, if by any chance the previous session liquidity area was not swept, we also have to consider it in our decision making for that day, especially if it's more closer to our current session liquidity. That is how basically you're supposed to do your analysis. Okay? That's how you're supposed to do your analysis. Look at the market, look at the behaviors. What is really happening on that market? Are we capable of getting what you want? Yes. Are we capable of getting the adjustment? Yes. Are we getting an opportunities in there? Yes. That is exactly what you need to do. If you do that, now it will be easy for you to execute the trade. I hope you guys are learning. Please confirm to me on the comment section if you're getting clearly what I'm saying. Because the most unique part of this trading idea or trading concept or trading methodology is that you have to be very careful in the decisions you're making in the market. Because any small decision, any small mistake you make, it will definitely cost you. And one of the toughest trading time is especially when you are trading when the market is sweeping liquidity. Sweeping liquidity comes with aggressive move, manipulated candles, okay? And candles are still moving very fast. And what you need to know is that brokers, most of the time, they cannot be able to capture manipulation. Do you know that? Your brokers cannot be able to capture manipulation. But if they were in a position to capture manipulation, they will always do something known as what you call slippaging. Okay? They will also be able to reduce leverage on your accounts. What is slippage? A slippage is the delay time between your execution time and the time they placed your trade actively, successfully on the trade platform. So the difference on those two times is what we call leverage. Oh, it's what we call slippage. You executed the trade at exactly 11:12.25 seconds, but they choose to place your trade into activation at exactly 11:12 at 57 seconds, meaning they have still 25 seconds difference. And that one alone can cost you, if by any chance the market is spiking. If the market is spiking on your zone and they just choose to exit to place your trades within a difference of 25 seconds on the slippage, believe you me, it will be very difficult for that trade of yours. And that is why trading is more of understanding exactly what to do. It's not by mentioning, it's not by telling us big what terms here in Forex. We understand those terms, but why are we not using it? It's about the practical part of it. And that is why most of the time, let me tell you this, that you need to understand as a trader, especially if you're a beginner. There's something known as what we call somebody who has graduated in the theory class in Forex. Somebody with an A plus in theory in Forex, but is called a D minor in practicals or the representation. Let me tell you, that person will still score a 0. And that is why, if you're very keen enough, you will realize that there are some traders who are very good in explaining things, but they don't have results. So the results comes from the execution. The results comes from experiencing the chart. And that is the big difference between, you realize that those guys who are doing, who are taking degree, and those guys who are getting diploma, the guys who are taking degrees, they have they have what you call enough content on the knowledge, on the theory part. But these guys on the with whatever they done, whatever plumbing, whatever on practicals part, they spend a lot of time on the practical. And practical is the results. And that is why you need to make sure you balance both sides, understanding it and be able to execute. Don't just base everything. You can be claiming all these terms. You can be telling us that gold is stable after hitting 3 months high, market top. You can tell us that. You can describe to us. But the only thing you can definitely become is just a Forex tutor. You cannot be able to execute. You don't have confidence. Your self-esteem is low. You're executing trades without following your rules. You're over trading. Even those traders who have skills, they still overtrade. They still use excess risk on their account. Why? Because they have not mastered the theory part of these things, the technical part of it, the practical part of it, the methodology in practical form. And that's why I'm telling you, you just need to know this. Let me tell you, you don't even need to know what is Forex trading. You just need to know that when this is a session liquidity, market needs to collect the session liquidity. Every time the market taps and collect the session liquidity, I need to know how to identify my order block. Which order block is valid on the execution of this trade? That is all what I need. That is exactly what I need for me to get the results that I want. These are the most common things that you need to know. Okay? Number one, understand the strategy you are using. That is the first part. Understand it fully. Do a lot of backtesting. Understand the connection between the dots of whatever trades that you are taking. And this one is so simple. I'm not here to confuse you. I'm not here to make you feel like, oh, this thing is not. No. I'm here for the sake of each and every one of you. Meaning, whichever amount of money, regardless of how small it is,